Greetings, my name is Benjamin Dimko, and together with Rashid, Disnisan, Dionyo, Abergan, and Abdulrahman, we will discuss and analyze Kamsa Mining Company's purchase of land and further investments in equipment and facilities. We will discuss how depletion and depreciation should be properly used during its operations and yearly extraction of minerals.
The primary accounting challenge that Kamsa Mining Company faces is how to accurately account for the depletion of its mining resources, as well as the depreciation of its related assets. This is crucial to ensure that their costs are being properly matched with the revenue that they are generating. A well-defined accounting policy will reflect the economic consumption of these resources, which ensures compliance with the PFRSs, specifically PAS 16 and PFRS 6. Otherwise, if improper accounting methods are being applied, then ethical concerns may arise. Thus, the management must exercise prudent judgment in applying and developing these accounting policies. Ultimately, our goal is to ensure that Kamsa Mining Company implements an accounting policy that is transparent, that is relevant to their stakeholders' needs, and that is faithful to their company's position.
And I will be discussing the analysis, particularly requirement A. So under this requirement, we will be preparing the schedule for the depletion and the depreciation for each year. First, for the depletion, we have the available information, and the method to be used is the output method. Now for the computation, we solve the depletable amount, which is the cost minus the residual value, which is equal to 87 million. And for the depletion rate, it is the depletable amount divided by the total tons to be extracted, which is 120,000, and we have 725. Now for the depletion for each year, we will be multiplying the depletion rate by the estimated tons to be extracted per year. So for years 1 and 11, it will be 4,350,000, and for years 2 until 10, it will be 8,700,000. In the next slide, we have the depletion schedule. And moving on to the depreciation, first we have the structures and sheds. We have here the available information, and the method to be used is the straight line method. Since the structures and sheds are considered as tangible development cost, this will not be capitalized and will be depreciated normally. Now for the solution, we have the depreciable amount, which is 3,600,000, since there is no residual value. And for the annual depreciation, we have the depreciable amount divided by the useful life, which is equal to 240,000. In the next slide, we have the depreciation schedule for the structures and sheds. Now, moving on to the depreciation for the mining machinery. Since the mining machinery has two classes, there will also be depreciation for each class. So first, for the first class of machinery, this class of machinery will still be useful even after the mineral resources have all been extracted. So it means that its useful life is more than 11 years, whereas its estimated years of extraction is only 11 years. So this means that the estimated years of extraction is shorter than the useful life. So hence, the method to be used will be output method. Now for the computation, the cost of the first class of machinery is 3 million, and for the depreciation rate, it will be 3 million divided by 120,000, which is the total tons to be extracted, and that is equal to 25. Now for the depreciation for years 1 and 11, it will be 25, which is the depreciation rate multiplied to the estimated tons to be extracted per year, which is 6,000, and that is equal to 150,000. Now for the depreciation for years 2 until 10, it will be 300,000. In the next slide, we have the depreciation for this class of machinery. Lastly, for the second class of machinery, this machinery will only be useful until one half of the present mineral resources have been extracted. So this means that the total tons to be extracted will be 60,000 tons. So the depreciation method to be used is the output method, and the cost of this class of machinery is also 3 million, since it is only half of the cost of the total machinery. So for the depreciation rate, it is 3 million divided by 60,000, which is equal to 50, and for the depreciation for each year, it is equal to the depreciation rate multiplied by the estimated total tons to be extracted per year. So for years 1 and 6, it will be 300,000, and for years 2 to 5, it will be 600,000. In the next slide, we have the depreciation schedule for the second class of mining machinery. In the next slides, we have the journal entries for each year. Kindly pause to read na lang.
So what is the depreciation and depletion assuming in year 1 actual production is 5,000 tons? So let's start with the wasting asset. The depletion for year 1 is 3,625,000 with the computation 725 times 5,000 following the depletion method. For the structures and shreds, the annual depreciation is 240,000 following the straight line method. For the first class of machinery, the depreciation for year 1 is 125,000 with the computation 25 times 5,000. For the second class of machinery, the depreciation in year 1 is 250,000 with the computation 50 times 5,000. Both the machineries follow the output method. Now, these journal entries reflect the 5,000 production. The actual production for year 1 is less than the estimated production. This resulted to a lesser depletion because as production decreases, the depletion also decreases and vice versa. However, the depreciation of structures and shreds remain the same due to the fact that it uses the straight line method, and straight line method does not depend on the production. The actual depreciation of both classes of machinery is less than its estimated counterpart. This is because the depreciation for the machineries follow the output method. So, a lesser production results to a lesser depreciation, and vice versa.
In this slide, we will tackle the rationale behind depreciation. So the reason why we use depreciation is it is for us to take account for the PPE given in the case study, which are the machinery and the structures and shed. However, we need to govern this by the past 16 in order for us not to mismatch expenses, especially to years where they would fluctuate. So in the past 16, it was stated that the depreciation method, there's no specified depreciation method for a specific situation as long as it best reflects the expected pattern of how future economic benefit embodied in the asset is consumed. So it was stated in the situation that for machineries, it was consumed based on the availability of the resources that would result on how much they could produce. Knowing the fact that it varies significantly by how much is available, we could use the production method. But for structures and shed, they don't produce, but rather they try to stand as long as possible. That's why we use the straight line method instead. For the rationale behind depletion, the reason why we use depletion, because given by the nature of the company, it's a mining company, and second, there are costs incurred in order for them to avail natural resources. So we govern this by the IFRS 6, how we financially report those costs and mineral resources. It states that the depletion can be presented through production and straight line, but we use production method instead because it does not meet the requisites of the straight line, which are it should be stated that the useful life of the equipment is shorter, and it is in the year of shutdown, which two of these are not mentioned in the case study. So we need this for accurate information, or else it would impact financially by overstating net income for high extracting years and understating net income for low extracting years.
Our recommended action for Kamsa Mining Company is to first use straight-line depreciation for structures and sheds due to consistent wear and tear regardless of mining activity, and to use production method for depletion and depreciation of related machinery to match costs with actual extraction volumes. Second, maintain detailed component tracking of machinery and anticipate production inefficiencies once part of that machinery becomes unusable midway through operations, because this may reduce output or increase costs unless new equipment is acquired or operations are adjusted. Lastly, reassess estimates annually and adjust for any changes to our estimates, useful lives, or production plans in compliance with past 8 accounting policies, changes in estimates, and errors. In conclusion, the case highlights the importance of aligning cost allocation methods such as depletion and depreciation with actual usage and lifespan of assets. Proper classification and planning for asset limitations like partial machinery obsolescence help ensure accurate financial reporting and informed operational decisions. The key takeaway is the vital role of proactive asset management and regular reassessment to support long-term efficiency and profitability in resource-based industry. And that would be all for our culminating output. Thank you.